It's hard to find reliable winners these days. But when you're looking at what's working, you know what? There's some really surprising names here. Do you know the best performing stock in the S&P 500 this year is CVS, up more than 53%? Meanwhile, Dollar General is in the top 25, up more than 17% for the year. All right, so what does CVS and Dollar General have in common? They were among the worst performers in the S&P last year, down 43% and 44%, respectively. Even coming into 2025, both companies were supposed to be in such terrible shape that no one wanted them. Things got so bad at CVS last year that the company ousted its CEO, Karen Lynch, in October. The front of the store part of their business was sluggish. The pandemic-era boom had long faded away as the COVID vaccine business dwindled, traffic slowed. At the same time, everything's locked up in the drugstores. An associate has to be found to open them, so the ultra-convenient Amazon has been eating their lunch. But the biggest challenge for CVS was their Aetna health insurance business. Like a few others in the industry, Aetna mispriced its Medicare Advantage plans and ended up with much higher than expected medical costs. Last August, the old CEO fired the head of Aetna and vowed to personally oversee the unit going forward. But she never got the chance because she was pushed out a couple of months later, replaced by a fellow by the name of David Joyner, who previously ran CVS's pharmacy benefit management subsidiary, Caremark. So put it all together, and it seemed like all of the company's plans since the Aetna acquisition in 2018 hadn't really paid off. CVS just seemed like a big, unwieldy operation where all of the parts were underperforming. As for Dollar General, the case against this one's more straightforward. If the company was already doing so poorly last year, what the heck was it going to do with all these tariffs, especially in China? I mean, the $2 store, here we come. So how on earth have these two losers become some of the hottest stocks in the entire market? There's a lot that goes into this. But at the end of the day, I think CVS and Dollar General both benefit from their newfound sole survivor status. Investors are piling into these two because their top competitors are falling apart, leaving CVS and Dollar General as the last men standing in their respective industries. Let's start with CVS. On the fundamental front, it doesn't hurt the CVS textbook recession-proof stock, right? Plus, back in February, the company managed to report better than expected numbers with a very nice revenue beat, stronger than expected retail same-store sales, a booming pharmacy business, and a sizable earnings beat. Wow! Better yet, CVS issued solid earnings guidance for the full year. Importantly, they sounded confident that they've gotten Aetna back on track, saying specifically that the medical advantage business, that's what really sunk them, was much better positioned this year. Management even started to say positive things about some of their recent medical care acquisitions, noting accelerating patient growth for their Oak Street business. I'd almost given up on that darn thing. Hey, by the way, after the company disappointed investors by cutting its earnings outlook multiple times last year, I mean, like time after time, it's worth noting that CVS just reiterated its full-year forecast last week, alongside some leadership changes. Oh, and it doesn't hurt, by the way. It got a 3.9% yield, even after its phenomenal run. I see why people keep coming back to the stock. However, the most important thing here is that CVS is indeed the last man standing in the drugstore space. Their chief rival, Walgreens Boots Alliance, has agreed to a deal to be taken private by a private equity firm called Sycamore Partners. And when a company like Walgreens gets taken private, they typically close a lot of their underperforming stores, practically gifting market share to CVS. In fact, back in October, Walgreens announced plans to close 1,200 of its then 8,000 locations over a 3-year period, with 500 of those closures coming before August. At the same time, they said only about 6,000 of the stores were profitable. Now, Sycamore's going to be running this show, and I think by the way, they're very good. And I think they're going to be even more aggressive at cost-cutting, including many more store closures. If it's really true that only 3/4 of the stores are profitable, then I wouldn't be surprised to see Sycamore close all 2,000 of the money-losing locations. I think that's a huge reason why CVS has caught fire here. Rite Aid's bankrupt. Walgreens is likely to close thousands of stores. They're the last man standing, all right. It's good to be the last man standing. Hey, by the way, just watch that Bruce Willis movie of the same name. Excellent Fistful of Dollars remake set during Prohibition. Speaking of last men standing, Dollar General's got the same sole survivor status going. Even though the company reported mixed numbers with underwhelming guidance a little over a month ago, these guys are turning themselves around. They say they're on track to deliver double-digit earnings growth starting next year, and that was enough to get the stock running ever since. You might think the dollar stores would be major victims of the tariffs, but last week, Citi published a piece arguing that Dollar General could actually be a relative winner. Why? Most of their peers were facing tariffs of 50 to 100% on their merchandise, but for Dollar General, it's really more like 10% because most of their goods are food and consumables. But honestly, the real story is that in late March, Dollar General's chief competitor, Dollar Tree, finally threw in the towel on its failed acquisition of Family Dollar. Oh, God, we broke that story years ago. They're selling the business for just over $1 billion after buying it for about $9 billion a decade ago. The buyers of Family Dollar are Brigade Capital Management and Macellum, two sharp investment firms well-versed in struggling retailers. Brigade teamed up with a real estate-focused investor at Arkhouse Management. We've seen them attempt to take over Macy's last year, ultimately proved unsuccessful. But they wanted Macy's because they loved the value of its real estate. That should give you an idea about how Brigade operates. They're looking to extract value by any means necessary. Meanwhile, Macellum's made a number of runs at struggling retailers over the years. We've introduced them to you, at Kohl's, Big Lots, Bed Bath & Beyond, and The Children's Place. So the assumption here is that these new bottom-line focused owners of Family Dollar will be aggressive with store closings after they take control of their business, likely within the next 90 days. Given that Family Dollar is more than 7,600 locations, we can expect many of these to vanish. And that is just terrific for Dollar General because of the proximity they have to so many of those Family Dollar stores. Here's the bottom line. CVS and Dollar General have caught fire this year because they're recession-proof businesses that are moving in the right direction. And they've both got key competitors that are likely to close many stores after being taken private. Anytime one of your top rivals goes into retrenchment mode, that's a win. CVS is the last man standing in the drugstore space, and Dollar General only has one real competitor left. They both have tremendous opportunities to take market share, and you know what? Maybe even raise prices. No wonder their stocks are roaring. They have money's back after the break.